This episode is sponsored by kineticwealthbook.com.
Okay. So we're all used to, I need to buy a house. I need to get some type of financing to buy that house. We call that a mortgage finance loan. It's going to be a loan that's secured by a home. And so you'll use that. Maybe you're buying a $500,000 house and you can put $50,000 down, but you need to finance $450,000 to make the purchase happen. That's called a forward mortgage. And when you do a forward mortgage, you're expected to make.
Welcome, everybody, back to another exciting show of the About That Water podcast. I'm your host, Anthony Weaver, and we are here to help the sandwich generation build strong financial habits so that they can talk about money, spend money, and enjoy their money with confidence. Today, I have somebody who has been working pretty much in mortgage lending as long as I've been alive, who stressed the importance of understanding the mortgage process and has an awesome book that I think you all would actually like to listen into. And I'm going to let him take care of that part of it. So welcome to the show, Ken Pitts. How you been?
Anthony, thanks for having me. Thanks for reminding me how old I am too.
You've been doing this for so long though. I got to give you your props because a lot of people usually give up on their jobs very quickly. To say, especially with a profession. I commend
35 years and counting.
Oh, and counting. Okay. But one of the things we want to dive into today, which is talking about reverse mortgages. Like I've heard about it. I've seen people get, quote unquote, shafted from it. And I just want to hear from your expertise about it. Like what makes it so appealing to you?
And that's a great way to start. I think what I found, Anthony, over my years, both offering that mortgage as a financial tool for folks in retirement, but also hearing a lot of the misconceptions. Listen, when I wrote this book, I didn't angle it just towards my end user clients. I also angled it towards financial planners because they were as misinformed as my clients were. And it's been an eye opener for them as much as it's been for my clients. And I just think it comes from a lot of misinformation. And also, I think, any new product that comes into the sphere of financing oftentimes goes through a couple of iterations before it gets perfected. And this product is no different. I would say that in 2014, there were major revisions made to the product that made it much more consumer friendly and I think a lot safer as a product. And when I say safer, it's not so much safer to use, but safe from people in my industry who misuse it with clients. And I think some of those things have made it a better product. But overall, I really wrote the book just really to give people a good background so they could understand, hey, this is what a reverse mortgage is. Here's how it can apply in your financial plan. Use it, don't use it, doesn't matter. Just wanted you to know it's out there. And I know that your podcast hits that sandwich generation. And that's where a lot of my leads come from because they're trying to figure out how to help their parents. And they're
really? I didn't think about that.
What can my parent, my parents are running short during retirement, but they have a house. How can we make that work for them? And I think that's probably one of the more refreshing things that I've seen out of this is that a lot of the referrals I get are actually people even younger than, I'm 62, they're younger than me, but they're trying to figure out a way to help their parents who maybe are, they're just finding they're not making ends meet with inflation and costs of goods going up.
Well, just keep going. You already brought it out. Like how could the people like me who's preparing for my mom to get ready for retirement help them with this process or at least educate them a little bit more?
Okay, so let's talk a little bit about just in general, how does a reverse mortgage work? Okay, so we're all used to, I need to buy a house. I need to get some type of financing to buy that house. We call that a mortgage finance loan. It's going to be a loan that's secured by a home. And so you'll use that. Maybe you're buying a $500,000 house and you can put $50,000 down, but you need to finance $450,000 to make the purchase happen. That's called a forward mortgage. And when you do a forward mortgage, you're expected to make a monthly payment, and that monthly payment is going to pay interest and pay principal towards the loan. Depending on Most first-time buyers, for example, get 30-year terms because they're affordable. So they'll spread the payments out over 30 years. They are front-end loaded with interest. So for the first 15 years, you're mostly paying interest. And then after that, you're mostly paying principal. So a reverse is the complete opposite of that. It's a mortgage. It's secured by a house. But what it's enabling you to do is go and grab all that equity that you build up over time and bring it back out. And you can bring it back out in a number of different ways, but it still functions like a mortgage. There's interest that's on the loan. The difference is in the reverse, instead of making a payment like you do on a forward, that interest gets deferred and gets added to the loan. That loan balance is going to go up over time, but you have no monthly payment for it, but you have access to the money. And that's the beauty of utilizing your house after retirement. You're able to actually tap into the long-term equity that you built out in that house and be able to get access to it. And there's real formulas that really govern this loan. And what I mean by that is, if you were going to go buy a house, we have to make sure you can afford the monthly payment. And so you have to make payments. Can you make the payments of principal and interest? Can you make your car note, your student loan, whatever else is out there? In a reverse mortgage, you don't really qualify that way. We just need to make sure that you can carry the expenses of the house. That's it. It's called a residual income calculation. And so when we're doing that, it's one of those calculations that is really easy to qualify for. So the reverse is a very easy to qualify for loan, which is, again, opposite of the forward mortgage, which is a lot harder to qualify for. But it was started by the federal government. There were actuarialists and gerontologists who knew people are living longer. They're going to outlive their money. We got to figure out a way to give them some alternative source of income besides Social Security and a pension. And that's how it all developed.
So what does it separate between the reverse mortgage versus a HELOC then?
So a home equity line of credit, if you use it, you will pay interest on it. You're going to have to come out of pocket and make a monthly payment. And on the reverse mortgage, you never make a payment. When you pass away, there's 3 trigger points on a reverse mortgage. If you die, your house sells, it pays off the loan. No different than a regular mortgage. Exactly the same. If you go into long-term care for more than 12 months, you need to sell the house and pay off the loan. Because what we know from actuarials are, if you go into a home for 12 months or more, you're not coming back out. Okay. And then the third piece is you got to keep up on your taxes and insurance. Because if you don't keep up with your taxes and insurance, and this would be no different than a regular forward mortgage, you're going to have an issue where you could be foreclosed on for taxes. And if that's the case, you've breached, your agreement with the lender because you're not taking care of the taxes and insurance. So those are the 3, what we call trigger points where you've got to do something to pay off the loan. Outside of that, you make no monthly payment, interest defers over time. And from an actuarial standpoint, they really designed the product so that there's some equity left over at the end. And that equity goes to the estate. And that's, your kids, if your kids are named in the estate or, whatever. But if you have a couple that are, a husband and wife that own the house and they're both on the loan, if one of them dies, the other one just stays in the house. It just keeps on rolling. So it's opposite of what we know about a forward mortgage.
Yeah, and it gets me thinking more questions of, well, you said there's no payments, but the interest get accrued on the back end. So, but we can make payments as if we wanted to go ahead on and pay off whatever we borrowed against the home, if that makes sense.
You're always open to make payments on the loan. But
they're going to take some money.
But the real application is where most people need it. They need it because they're falling a little bit short monthly. It's the saying they have more month than money. And they're using that they're using their house to tap into the equity to make up that difference. When you're using it in that way, generally speaking, you're probably not going to pay it down, but you can. I mean, some people maybe have a spouse, she passes away, leaves you life insurance. You could use that life insurance to pay down the loan and open up that line again, keep using it. So it does give you some
Got you.
flexibility in that regard.
So what does that allow the borrower? So say if they want to consolidate debt, they can go down and use this particular reverse mortgage. But how do you kick it off then? So say if somebody they say like, hey, my strategy, my financial strategy, this is me. I don't have any other assets. I don't have any other investments. I really don't want to tap into my 401k, but I do have a property. I have like at least more than 80. Do you need to have at least a certain percentage before you can start this reverse mortgage thing?
So typically a reverse. So you have to be aged, if you're using the FHA version, for example, you have to be 62 years or older to begin to use it. Generally speaking, it's three factors that go into it. What your age is. So we look at your birth date, we look at the value of the home, and we look to see if you owe anything currently on the house. Those three things will determine whether this product's going to work for you or not. And it probably will make cognitive sense as soon as I tell you. The younger you are, the less you can borrow. The older you are, the more you can borrow. Because think about it, this loan's growing over time. So the longer the loan's going to be out there, the more it's going to grow as you're using it and you're accruing interest. So when typically, if you're trying to take it out at age 62, 65, 68, you might get about 40% of the value of the house as a reverse mortgage. But as you get into your 70s, and I've done some for folks in their 80s, they're getting more like 40, 45, 48% of the value of the house based on today's interest. So if interest rates drop, they give you more access to more money because the loan's growing slower. So those are two really important factors outside of, okay, what's the house value when we look into it? So it's looked at completely different than a forward mortgage. Again, it's the reverse. Everything's based on an actuarial of how old you are, what the interest rates are, and what the value of the house is.
Okay. Does it matter what type of house? Because I'm thinking of like people who have condos, double wides, or if they just have, like, say if they left you land and it's just kind of hanging out there, ain't nothing going on with it, but it's paid off. And like, does it matter what type of asset?
Good question. It has to be your primary residence.
Okay.
It can be a condo. It can even be a double wide manufactured, provided you own the land. And single families, I've seen duplexes allowed, triplexes, as long as you're living in one of the units.
Oh, really? Okay, now you're piquing my interest. Tell me more. Because with the quadplexes, that would be great.
Yeah. So if you, like I've told my kids, and when you buy your first house, try and make it a duplex. Somebody else will pay your mortgage for you, right? So if you were lucky enough to have done that, you're living in that house, that you're living in one unit, you rent the other unit, that works on a reverse mortgage, as long as the numbers make sense, right? Age, interest rate, value of the house. If there's equity there, you can go get it on a reverse. So, and you can use this thing as a financial tool in so many different ways. Like, I'll give you three basic examples. Let's say you're 68 years old, you still have a balance on your mortgage. So you're making a monthly payment. Well, what if I can eliminate the monthly payment? What if I have enough equity, I can knock that monthly payment out? Well, if my principal and interest payment is $1,200 a month, and I knock that $1,200 a month expense, guess what now goes longer? My Social Security lasts longer, maybe my pension or my 401k draw. And maybe I don't have to draw as much on my 401k as a result of it. So, those are really nice, just financial twists you can do just by knocking that payment out. Now, I've had some people who have looked at this as a bridge to hold off Social Security. So they were looking at maybe taking Social Security out at age 62 or 65. But if you can wait till age 70, you can almost double what Social Security will give you. So they had all this equity in their house. And what we discussed was, hey, what if you take what you would have gotten at age 62 on Social Security? What if you take that out of the house via reverse mortgage for the next 8 years? You don't have a payment on it, but it gets you to age 70. And now you've doubled if it's age 62, you almost triple what your Social Security benefit would be. So from age 70 on, they have significantly more Social Security income. I mean, that's called a delay bridge. You're buying time by utilizing the equity in the house within the reverse mortgage to get you there. So that's another possible way to do it. And the third is a way that a lot of financial planners recommend. They recommend folks have a home equity line of credit on their house for emergency expenses. And I agree with that. I think that's a good philosophy because you don't want to be smashing into your 401k because you got to get a new car or you have, a medical expense that wasn't expected and you're hitting your 401k at the absolute worst possible time. Markets are down or something like that. You're losing, on both ends, where if you could just tap into your reverse mortgage, pull that money out as you need it, now you have options. Maybe you pay that money back when the market rebounds. Maybe you don't pay it back at all. You just let it run and you let the market continue to run. So you have different options available to you with the flexibility of this program. And those are just 3 examples. And I could give you 30 clients have come up with and mixing and matching them,
Right.
There's all different ways to do it.
But this is really good information for people to at least know, reminding everybody, hey, these are educational purposes only, because this is just to let you know this is another tool that you can actually utilize in your toolbox, in your financial toolbox. Because I just don't want you to think of budgeting as your only tool. Everything looks like a budget at that point. Sometimes life happens and you just don't have your money by the time you're getting close to retirement. Life happens.
And good point. And life does happen. And the best laid plans sometimes get waylaid. And I think that's really important. Just real briefly on that whole line of credit versus reverse line of credit. What a lot of people don't realize, even some of the financial planners I interviewed for my book, if you get out a line of credit and say you take it out at age 65 and it's going to be your emergency account, the bank doesn't have to keep that open. They can call that line at any time. They can't call a reverse mortgage in. Once it's open, lasts you. And that's and you don't have to requalify for it. Where a line of credit, you could be called in to requalify for that loan after 5 or 10 years. Reverse mortgages for life. That's an important point.
Now, is there wanted to understand, because a HELOC, you only got to pay interest on it as you use it. Is a reverse mortgage the same way as whereas hey, if you have it there, you don't touch it, but it's just there. Do you still have
even better than that? Even better.
Really?
Because if you don't touch whatever portion of the line of credit you don't touch, grows and gives you access to more equity over time. A home equity line of credit doesn't do that. Whatever you borrowed. That's it. The reverse is designed to give you access to more equity, because what we know about real estate is we've had some down years, but over time, it moves with inflation. And you're going to, in the area where I live, nothing special about where I live. We average 6% a year in this area. So the line of credit is going to expand out and give you access to more money over time if you're not using it. So for some people, I've put these lines of credit in place and they're like, well, I don't really need it now, but I think I may need it 4 or 5 years from now. I'm like, then let it grow. If you take it now, you can let it grow. There's no guarantee of if we do this loan 5 years from now, how much you're going to get out of the house. Right now, we know what it could grow to. And usually that's, when you start running the math on it, and there's economists like Wade Pfau. Wade Pfau is a very well-known retirement economist. He has been a big proponent of this program for years. He will write out and tell you, if you're in your 60s, you need to get one and just let it sit, because you can tap it later and you won't have a payment.
Gotcha. For the sake of time, man, I have so many questions, but we only got a short period of time. But I want to talk about the futures here. We talked a little bit about yourself. You've been doing this for so long. You have a love and a passion for it. But why do you keep going? Why is this so important to you?
Particularly this loan. Look, I'm 62. It's coming on my horizon. Which was a part of the reason there was both a selfish interest and an interest for my clients to understand this product. Every time that I do one of these products, I can see just the release of stress on my clients. Okay, I have a solution. Okay, this will work, and I have them using it across the gamut of different options. But when I can see that click, that motivates me to go to the next one, because it's a different experience. The one thing that I find unique is you can't really broad brush everybody's financials. Everybody's a little different. Different things happen to people and puts them in different situations. I just love being able to go in and just work with the client, try and meet their need and say, okay, here's how this will solve this problem. And we go forward. It's, as I say, luckily it's not a one size fits all kind of product. It's got that flexibility where it can solve different problems for different folks. But the way I look at it is, as long as you know the solution's there, you can pull the trigger whenever you want as a client with me. You let me know when you're ready, but I'm going to make sure you know all these different options that are available to you with it. And I think that's what motivates me, because I can see the solving. I can see that, the solution is there, and that's exciting.
That's amazing. So we're going to go to this third segment here, which is the futures. Like, what areas of focus of improvement in your own life or even your career that you feel that you're working on now?
I think I'm always chasing efficiency.
Okay.
Making sure. I mean, for me personally, always trying to make sure that I'm doing first things first. As I'm from the Philly area, Jalen Hurts always says it best: keeping the main thing, not getting distracted by things out in the periphery. Keep the main thing, the main thing. And I think that's probably the thing that I always come back around. It's a good struggle, because as you can perfect that over time, you become, I just think, more efficient but clear thinking. When you can really focus and keep the main thing, it keeps you very clear minded, I think, and that's been something I've worked on my entire career. Not always successful.
Awesome. That's a good thing to think about it. I totally understand. Is there anything you want to leave the audience, the person that's listening right now, before we dive into the final four?
When I was writing the book, and it's actually in the book, I try and tell people this all the time. The internet is a great place to form questions. It's a great place to get information, to ask good questions. It's not always the best place to get answers. And, you have to have some trusted professionals in your life that you can go to, but go to them with questions. I'm fine with somebody researching reverse mortgages on the internet and finding out every possible horror story, because I generally can probably explain why those things happened and how the product maybe wasn't applied correctly, and this is why it happened. Or folks weren't, really counseled well in how to use it. And so, yeah, the internet, great place to form questions, not always the best place to get answers.
Awesome. Well, you ready for the final four questions?
All right, here we go.
All righty. Number one, what does wealth mean to you?
I think for me, wealth is security.
Number two, what was your worst money mistake?
Got into developing real estate and wanted to get out in 2006, stayed until 2008, took a pretty good beating.
Right. That's a whole nother episode.
Oh, it is. It's a funny one.
Number three, is there a book that inspired you on your journey or changed your perspective?
Yeah. I mean, I could tell you that, for me, there's a book called Rediscovering Jesus. And I found that one of the premier books for getting me back into studying the Bible and really looking at it as a way to lead your life. And I found that book was just awesome. If you get a chance to read it, it's fantastic.
Number four, what is your favorite dish to make?
Now, listen, I cook. So
really? Okay.
Yeah, you don't have to categorize that question. I'll tell you what I got. I'll tell you what I got.
Not going to Ramsay cooking. You cook it. Okay.
Let me tell you, I love all kinds of stuff. But I did get into making my own sourdough. And so I make different types of sourdough bread on a regular basis. I make a couple loaves a week, soft pretzels, bagels, pizza dough, outside of bread making. I love it. My nephew got me into it. He's another cook.
Nice.
But yeah, between the two of us, we share recipes back and forth and things like that. But there's nothing better than breaking bread with people. And if you make a good sourdough bread, people love it.
And that's a whole, literally breaking bread with people. That's great.
Yeah.
So this is the last question of the show, which is, where could people find out more about you?
So if you go to my book website, which is kineticwealthbook.com. So you can kind of see it behind me there, kineticwealthbook.com. You'll get all my contact information there. Even though I'm a licensed loan officer in 4 states, Pennsylvania, New Jersey, Delaware, and Florida, if you're not in those states, call me anyway. I would love to answer any questions you might have about reverse mortgages. I'm a real proponent for the program, and anybody has any questions, great. You can order my book on that site as well. It's a good read in that it's only 133 pages, so most folks can read it in a day or two, and it'll get you asking questions and seeing applications. That's what it's designed for.
Yeah, and also you can get the first chapter of your book too, go on your website.
Yeah, get the first chapter free.
There you go. Man, Ken, thank you so much for stopping by to share your knowledge to the person that's listening or decided to listen to this episode. And I commend you for everything that you do. And the person that's listening to this, I want you to realize that you've already taken the first step to understanding, hey, this is a brand new financial toolbox for your family, either for you, for when you get older, or your parents, if they're still alive and you're supporting them and you just don't know what else to do. You just can't afford to move them into your place and you can kind of retire in place for just a little bit. This is an option for you. But also, these are things that you can also talk with your financial planner. And this is a great way. Thank you so much, Ken. I can talk about this a little longer. I wish we had more time. But if you, the listener, think we should have Ken back on to talk about a part 2, really taking a deep dive in some of his special stories, some of the horror stories, and how to get out of it, please drop something I'll just say drop wallet in the in the comments on YouTube, and or if you're listening to this on Spotify. I wish you all the best. Y'all be safe. Be out. Peace.
Thank you, Anthony.